On January 1, 1999, European leaders executed one of the most ambitious macroeconomic experiments in modern history. By abandoning individual national currencies for the euro, they sought to permanently erase the friction and high cross-border transaction costs that the classical economist John Stuart Mill once called a state of barbarism. But decades before the first euro coin was minted, a foundational warning had already been issued. In the 1960s, economist Robert Mundell pioneered the theory of optimum currency areas. Optimum currency areas, or OCA, is an economic framework that maps out the exact geographic and financial conditions required for independent regions to safely share a single currency. The most severe threat Mundell identified in a currency union is an asymmetric shock. If two countries share a currency and Region A falls into a deep recession while Region B experiences a rapid economic boom, a centralized central bank is forced to set a single interest rate for both. That uniform policy becomes a blunt tool, incapable of addressing both extremes simultaneously. Without a national currency, the struggling region loses the ability to devalue its money, to make its exports cheaper, and escape the downturn. The Eurozone was forged primarily as a massive political project to drive European unity, yet by locking diverse economies into a single monetary system, that political dream was intentionally chained to strict, unforgiving laws of macroeconomics. To survive an asymmetric shock without a local currency to devalue, Mundell's theory dictates that a region must possess a strict set of alternative shock absorbers. Specifically, the region needs massive cross-border labor mobility, so jobless workers can easily migrate to booming areas, and highly flexible domestic wages that can adjust downward during a crisis. An even more critical requirement is a fiscal union. This is an automatic, supranational tax and transfer system. In a functional fiscal union, a central federal budget seamlessly redistributes tax money gathered from thriving regions directly into struggling areas via unemployment benefits and stabilization grants. Prior to the launch of the euro, the participating European nations failed nearly every single one of these structural prerequisites. Linguistic and cultural barriers severely restricted labor mobility. Strong unions and stringent employment laws made wages notoriously rigid, and member states fiercely opposed cross-border fiscal transfers, keeping the central EU budget capped at roughly 1% of the bloc's gross national income. By actively ignoring these rigid preconditions, European leaders deliberately constructed a massive monetary roof without laying the necessary fiscal and structural foundation to support it. This is a flowchart illustrating the competing economic theories surrounding the euro's launch. To justify building the currency without the required foundations, politicians relied on a theory championed by economists Jeffrey Frankel and Andrew Rose, known as the Endogeneity Hypothesis. This hypothesis made a massive real-world wager. It argued that a country doesn't need to meet the strict criteria for a currency union before joining. Instead, the simple act of sharing a currency and lowering trade costs will inevitably deepen intra-industry trade. This surge in trade acts as a transmission mechanism, organically synchronizing the business cycles of the member states after the fact, ultimately resulting in a stable currency area. A formidable opposing view emerged from economist Paul Krugman, rooted in the Specialization Paradigm. Looking at the right side of this diagram, Krugman warned that eliminating currency risk and trade friction actually causes industries to leverage economies of scale and cluster in specific geographic regions. This agglomeration causes individual member states to become highly specialized in specific industries, guaranteeing that future macroeconomic shocks will be heavily asymmetric and deeply destabilizing to the Union. The creation of the euro was a high-stakes experiment played out across an entire continent, betting that economic integration would automatically breed structural convergence rather than extreme vulnerability. When the global financial crisis hit in the late 2000s, empirical data quickly proved Krugman's specialization paradigm correct. Capital flows abruptly stopped, and severe asymmetric shocks swept across the highly specialized, heavily indebted economies of the European periphery. To understand why the Eurozone suffered so intensely, economists look at a metric called risk sharing. Risk sharing measures how effectively a functional currency area disperses the financial pain of a localized economic disaster across the broader union, protecting local living standards. This chart displays the percentage of an idiosyncratic GDP shock absorbed by different economic channels. Looking at the top bar representing the United States, deeply integrated capital markets and automatic federal tax transfers successfully absorbed and smooth out roughly 75 to 80% of a local economic shock's impact. Panning down to the Eurozone data, the contrast is stark. Because Europe has heavily fragmented capital markets and zero central fiscal union, it manages to absorb a mere 13% of a localized shock. That leaves a massive 87% of the economic drop completely unsmoothed. When 87% of an economic shock hits a local population directly, and the government cannot print or devalue its own money, the nation is forced into internal devaluation. This requires aggressive structural reforms to drastically cut public spending, slash nominal wages, and drive up unemployment in order to physically force down the domestic cost of production. Without centralized shock absorbers, the Eurozone relies entirely on an adjustment mechanism that inherently destroys the economic livelihoods of its citizens and severely fractures the political cohesion of the entire bloc. The original theory of optimum currency areas accurately diagnosed the need for labor mobility and fiscal transfers. However, it contained a highly dangerous silence. The 1960s blueprints failed entirely to model the threat of a hyper-financialized 21st century commercial banking sector acting as a massive shock amplifier. This blind spot birthed the Eurozone's most acute, unresolved vulnerability, the sovereign bank doom loop. The doom loop is a self-reinforcing downward spiral. When a sovereign government faces a debt crisis, the market value of its bonds plummets. Because domestic banks hold massive quantities of those exact government bonds, the drop in value instantly destroys the bank's equity capital. Facing systemic banking collapse, the national government is forced to step in with a massive public bailout. That immense cost is added straight back to the national debt, degrading the sovereign's creditworthiness even further and reigniting the cycle. By fully centralizing monetary policy under a single currency, while leaving bank regulation and the burden of bailouts entirely decentralized, the architects of the euro effectively wired a systemic self-destruct sequence into the European economy. While the Eurozone survived the sovereign debt crisis, it remains a highly fragile, suboptimal currency area. It relies almost entirely on the intervention of the European Central Bank, which functions as the single centralized pillar holding the system together. To achieve long-term resilience, two strict institutional fixes are required. First is the completion of the banking union through the immediate implementation of a European Deposit Insurance Scheme, or EDIS. EDIS is a proposed supranational guarantee for retail bank deposits that would permanently sever the doom loop by mutualizing banking risk across the entire bloc. The second requirement is a permanent fiscal union. Temporary, ad hoc pandemic recovery funds like Next Generation EU must evolve into a permanent, centralized fiscal capacity capable of executing automatic macroeconomic stabilization across borders. However, enacting these missing pillars requires a profound level of political solidarity and mutualized debt that core European nations remain fiercely resistant to accepting. The history of the euro proves that immense political will can temporarily override economic fundamentals, but to ensure its long-term survival, Europe must finally build the complete federal structure its founders envisioned, but never finish.